Hello and welcome to Unleashed. I'm your host, Will Bachman, and I'm so excited to be here today with Jenelle Sheridan. She is a strategy and alum, and she is the former VP and GM at Athleta. So we're going to talk today about how to analyze a retail company. And Jenelle has done it as a consultant and also, more importantly, as a operating executive. Jenelle, welcome to the show.
Thanks so much for having me, Will. Excited to be here.
So today, thank you so much for coming. And we have this Umbrex resource now. Listeners, you can follow along. If you go to umbrex.com/resources and then scroll down or Control F for how to analyze a retail company, you can click on that resource. We have 35 different detailed analyses that we walk you through. Jenelle is going to talk about some of the most important ones, some of the ones that she looked at. So Jenelle, lead off. First, why don't you give us just a little bit more about your background than my very cursory intro?
Absolutely. So, I have 15 plus years of experience working in retail and e-commerce. As Will, you mentioned, I've worked as a consultant as well as an operator. My work has spanned with both pre-revenue startups all the way to larger enterprise businesses. Most recently, I launched my own consulting and advisory practice. It's called Farview Partners. We partner with consumer and retail companies, really helping unlock growth. So everything from, clear market positioning, expanding into new markets, points of distribution, and then developing actionable operating plans. So that's been incredibly fun. And as you mentioned, prior to launching Farview, I served on the leadership team at Athleta for almost 10 years. I helped lead our strategic growth from a $200 million business to over $1 billion. So saw a lot during that time and happy to share some with our listeners today. I launched and led our international business. I ran a new division. I've launched new channels. And so, quite a journey at Athleta. I also held functional roles in marketing as well as strategy and business development. So prior to Athleta, I was a management consultant. I was at Strategy and focused on retail and consumer clients and really focused on growth. So, during that time, we looked at a lot of companies, businesses, divisions. As I mentioned, I launched some. And so a lot of these metrics that you're providing to your listeners and your followers are really, really important as we are considering, what success looks like. So I'd love to jump in and talk about kind of how we look at performance.
Let's do that. I think before we start recording, you were saying, hey, I want to focus on the big three. So just dive in, lead on.
All right. Sounds good. So, there's so many ways that you can look at company performance and gauge effectiveness. You outlined 35, I think, in your guide. And as an executive, I've overseen businesses across so many stages of maturity. Your definition of what success looks like and the metrics that you focus on really do change depending on the stage of growth of the brand. So, for instance, if I'm evaluating an emerging retailer or a brand, I'm likely more focused on, some of these growth metrics like brand awareness, customer acquisition, revenue growth. I'm less focused on overall profitability, at that stage of the game. And now if I'm a more established player, I'm likely more focused on driving operational efficiencies. So metrics like inventory turns or return on gross margin, those are super critical metrics. But, getting back to this big three, regardless of the stage of maturity of the retailer, I think there are a couple metrics that investors are incredibly keen on tracking. And then there's some of these emerging metrics that we can talk about too, that really focus on the customer and brand health that, really encompass the omni-channel point of view as well. So, let's start with the big three. And I think, the first one, you really can't talk about retail, traditional retail, that is, without talking about same store sales growth or sales comps. Here's what this means, right? Same store sales growth really measures the change in revenue for stores that have been open for at least a year. So what this does, it really helps isolate the organic growth. You can open more stores and obviously you see your sales go up, but that might be masking the performance of some of these underperforming stores that are in your fleet. So a strong sales comp metric, this indicates increasing consumer demand or successful product strategies. Conversely, a low or negative rate may signal challenges or market saturation. You might need to reposition, right? So in terms of putting some numbers around this, what does good look like? Best in class sales comps are in the 5 to 7% range. You can look at this across, apparel, grocery, numerous categories, right? So, Costco, that's, a retailer that, we all know and I love personally. They just delivered comps around 5%. Lululemon, they've been a darling, although, a little bit of slowed growth lately, but they deliver around 8% from a comp standpoint. So that's kind of what best in class. I would say industry average is more around 2 to 3%. So, I think, again, same store sales growth for traditional retailers that do have a fleet. This is a metric that is reported out on regularly. Investors really look to this to say, is a brand performing well? And, is something that, most brands really do track on a quarterly basis, even a monthly basis.
Is that adjusted for inflation?
So there are adjustments for currency. It is not adjusted for inflation. So if you're, operating across multiple regions, you will adjust for currency, but there is no adjustment for inflation. Yeah.
And so, at some point, is it bad if a store is basically flatlining? I can imagine in some neighborhoods, some stores, I'm not going to buy more groceries or get my hair cut more often or drink more than one coffee a day or whatever.
Yeah.
Like my local Starbucks, or my local grocery store. So is there some point where you'd say, well, okay, mature, 0 is fine?
I would hate to say 0 is fine. If I was delivering 0% growth, I would not feel like I was delivering for my shareholder community and my leadership team. But there is a point where, at inflation can make sense for a mature brand. I do think, though, it begs the question, as your, rents are increasing, cost of goods might be increasing along with inflation. If you're not keeping pace, then you're not actually delivering the growth that you might need. What we more often than not see when we have, flatlining or even decel from a sales comp standpoint is something's not healthy and or right. So, you might have too big of a box. You might have, challenges in your assortment. You might, need to rethink your pricing strategy. And then you're often seeing the underlying metrics that actually contribute to sales. So for example, your foot traffic, your conversion, your, basket sizes, those metrics are often also decelerating at the same time. So your point about, I'm not going to necessarily buy 2 coffees a day. I'm going to buy my 1, that holds. However, what can happen when you're seeing these flatlining or decelerating sales comps is your traffic metrics are increasing. So Will, instead of coming 5 times a week, Will is coming 4 times a week to get his coffee. And, you're not doing a good job potentially building a basket. So eventually, Will, we'd like you to buy a coffee and a muffin. And we're putting a lot of marketing efforts and dollars to do that. And if you're not, then we're doing something wrong. So, you do want to see some growth because otherwise you won't be keeping pace with your accelerating costs.
So I guess that would be the top line number you look at. And then to understand it, you'd be trying to understand, well, what sort of, if let's say it's going up, okay, well, that's good. But is that because the prices were just raised by 10% or they sold 10% more units, right?
Exactly. You do really need to look at the underlying drivers. Sales is kind of that top line, that's what you're tracking. All right. Are things going in the up and right direction? There can be a lot of things going on under the covers. So, I mentioned a couple of metrics that contribute to sales. So for stores, your traffic, so the number of footsteps that are actually coming into your store, your conversion rate, and or your transactions. So that's, the number of folks that come in, what percentage of those are actually buying something. And then you get to the basket, which is comprised of 2 components. It's typically the units per that transaction, as well as the average price for that transaction. So when you break it down, there's actually a number of metrics that contribute to these sales. What we've been seeing a lot in the industry is, traffic numbers in stores are not going up. We have a lot of folks that are shopping online, and that's when we'll start to talk about our customer metrics, because you can actually have healthy customers, even if you're seeing some of these decels in some of your store metrics. So traffic, we've seen that it has been coming down, declining, but what you typically see when you have traffic coming down, your conversion rate is going up because you have more intentional buyers coming into the store versus what I like to call looky-loos, who might be coming in, trying something on, et cetera. You folks that are actually coming in, really willing to make that transaction. So what we see is kind of an evening out with those metrics. What we do typically see holding is that basket size. So we typically see your overall basket is about the same. We do like to see that slightly ticking up because prices do go up typically over time. And your units are holding. So that's typically the relationship we're seeing in stores is, holding to a slight acceleration, not necessarily being driven by traffic, but more so, that conversion as well as upticks slightly in the basket size.
Which of those, you mentioned that public companies would report out their same store sales growth.
Yes.
Which of those metrics underneath that are reported? Do they report store traffic or conversion rate or basket size?
It really depends. Traffic is the most commonly reported metric. And you do have some brands and retailers that are reporting out on, I'll call them lower level metrics. Oftentimes it's not, every quarter. They might, if they have some nice metrics to report out, they might decide to report them out. And what I've seen is a lot of them are actually tied more to the customer. So they're saying, our average customer is spending X per year versus, actually pointing to more of the transaction level metric.
Interesting. Okay. All right. Wow, this is fascinating. Okay, we could spend more time on this.
Yeah.
Let's go on to the second metric.
Sure. The other metric, what I would consider in the big three, is gross margin. So we talked a lot about top line. Gross margin really gets to, a bit around profitability. So this reflects the efficiency with which a retailer manages its costs relative to its sales. So high performing companies use pricing power or efficient supply chains to achieve, top tier margins. What does this look like in practice? Best in class or luxury brands sometimes can have margins 60% and above. Mainstream brands, more so in the 30s. So like a Louis Vuitton, for example, they're selling, infrequent goods, but their margins, 69, 70%. Lululemon, they've also enjoyed some very healthy margins, given some of their pricing power, 58% or so. Gap, a little bit more of that mainstream, 38, 39% margins.
Just to define that,
gross
margin would be the price the consumer pays minus the cost the retailer paid for that product. It doesn't count though any of the store costs, right? So
that's correct. That gets down to your profit margin, right? So this is talking a little bit more from a supply chain standpoint, what you're able to, your sales less your cost of goods.
Cost of goods. Okay.
Yep. So, again, it really depends on where you're at in kind of that value proposition for your customer. And then, as you think about some of the costs that you mentioned below, again, your structure is going to look a little bit different if you are a luxury goods retailer versus a more mainstream retailer. And, margins vary, if you're an apparel retailer versus, a grocery. So there is some variability there. And as I mentioned, this is important to look at once you're established. So, if you're a startup and if you're a newer brand, it is important to keep an eye on these costs, but this is not necessarily going to be your North Star. You're really looking for kind of growth and acceleration. But again, gross margin is one of those three that, investors look to. It's if you're reporting out, this is something you're reporting out on regularly. And it really is important to track from just an overall efficiency standpoint.
So what would be considered good would probably depend a lot about what sector you're in. Like, so grocery
Absolutely.
would be, super low margins, I would imagine.
Absolutely.
Versus, luxury apparel, right?
Absolutely. And, again, it gets to that frequency of purchase too. That's why, these are great metrics to look at. Some of my favorites that we're going to turn to focus more so on the customer.
Okay, cool. And one that I've seen, which I know is not one of the big three, but I guess is the average sales per square foot, right?
Yes.
And, I guess I've seen numbers where like Apple is sort of 10 times the number two store, like just sort of crazy numbers where like the number two store I think is what, 400 or something, and Apple's like $5,000 a square foot.
So let's talk about sales per square foot. Again, a very traditional retail metric. So these are so sales per square foot, for your listeners, it is kind of what it sounds. It's basically how many dollars you generate based on the number of square footage your average store is. So if you have a 5,000 square foot store versus a 1,000 square foot store, you actually can kind of inflate, if you will, your sales per square foot. Typically, if you have a smaller box, your sales per square foot on average is a little bit higher just because you're kind of cramming more goods into a smaller space. But, as you mentioned, Apple, they are certainly a shining example of, very high sales per square foot, even with large box sizes, just given the price point of their products. It speaks to efficiency. It speaks to, the product resonating with the customer. It speaks to excellent visual merchandising. So a lot of things do go into that. Again, that's kind of that sales comp, sales per square foot, very top line metric. Lulu's another one. I think their sales per square foot recently were like $1,600 a square foot. So, they're churning it. These things are all related, right? You're turning your inventory incredibly fast. Your pricing is right. And you're kind of firing on all cylinders and making that real estate investment worth it.
Okay, great. So we talked about same store sales growth, gross margin. What's the next one that you look at?
Yeah. So, and I just alluded to it a bit, inventory turns, right? Retail is a game of owning inventory, and you really need to think about how frequently you're turning over that inventory. So inventory turn is basically how frequently a company sells and replaces inventory over a period of time. So high turnover indicates, you have a well-aligned supply and demand management process. Low turnover can suggest you have inefficiencies or excess inventory. It is very expensive to sit on excess inventory, and then you can't necessarily bring new goods in. So, I'll give you some examples. A retailer like Zara, so they're known for very fast moving inventory. They can hit 7 or more turns annually. Larger, more general merchandisers might do 4 to 5 times from a turn standpoint. So again, very industry specific. And then it's also category dependent. So, if you're a retailer and you are an apparel retailer and you carry everything from like outerwear to accessories to, some basics, it is helpful to perform this inventory turn analysis by category. This helps you identify fast moving versus slower moving items. And this allows for more precise management and buying. So, if you have a new product and you're expecting it to turn, at, 6 or 7 times and you're seeing it turn at 2 to 3, if you have a fast supply chain, you can typically respond to your buy and then, make a smaller buy the next time. And so you're kind of managing your supply and demand that way. Fast moving categories are things that people are purchasing more frequently. So things like basics, if you're thinking of apparel. Slower turning, we talked a bit about luxury. Those are, typically slower turning categories, even things like formal wear, very event specific things. And so it really is to a function of, making sure your buys are matched up with the demand for those specific categories and items. So again, just a very helpful metric to look at, especially as you're getting a little bit more established so that you're optimizing your inventory and your kind of capital dollars.
So that helps you get a sense of, because it takes a lot of capital to own all that inventory or to pay for it, and space to store it all. So if you can move it through there quicker, that's much better.
Absolutely. Absolutely.
Talk to me about some of the customer metrics. I think you wanted to get into them.
Yeah. So, those are the big 3. What has become increasingly common for a lot of retailers to look at are customer metrics and overall brand health. I love looking at customer metrics because this gives you an omni-channel view. You also have the ability to segment based on, your various customer personas. If you're kind of doing that, you can look at new versus existing customers. I find it a very actionable way to look at your data. So a couple things we like to look at. So we typically look at a rolling 12 view of our customer file. So, you can pick a point in time, we're sitting in October. We would look at, a rolling 12 historical view ending, October 2024. And looking at a 12-month cycle really does help you capture, a customer's buying behavior, right? When you start to look at more short truncated periods, the data just isn't as telling because, again, it depends on what category or segment of retail you're in. But I like to look at a 12-month buying window specifically for apparel. So some of the things we like to look at, spend per customer. This is a really important one. This is driven by frequency of purchase as well as spend per purchase. And your spend per purchase, as I talked about, in some of our sales metrics, is a function of the units that she's buying in that particular transaction, as well as the average price of the items within that transaction. So as we look at spend per customer, a couple things. One, our goal is to increase this over time. Now, how do we do this? And this is why I love looking at customer metrics. It's very actionable, right? So you can build her basket based on the breadth of your offering. That's one way to do it. Another way to do it is drive additional visits. How do you drive additional visits? You might have, more frequent or exciting product drops. You might have a promotion. So you can pull levers in a very customer-centric way, even very much so by segment, when you start to look at things this way versus just broadly, all right, here's my sales. All right, let's try to get more footsteps in the store, but who am I actually talking to? And so anyway, I love looking at customer metrics. And as I mentioned, you can really segment this. So one way I really love to segment this is new customers versus existing customers. You're going to, when you look at the data, you'll see very natural differences in these segments. What we typically see, newer customers usually have a lower spend per customer, especially that first 12 months. Typically, we see this driven by lower frequency, because she's new to the brand. She might come once. Her basket is shockingly usually similar to an existing customer, but what's really driving that lower spend is, that one, maybe two visits. Existing customers have a higher spend per customer, typically driven by frequency. Another way that you can segment these customers is by, product category or type of customer. So like we look at our customers by division, like, oh, this is a women's only shopper, or this is a women's plus girl shopper. If we know women's only shoppers have a presence of girl and household, how do we get her to be a women and girl shopper? And so we can actually put together some tactics to really drive this spend per customer metric up. So I'll pause there because there's so much richness when you look at the data this way.
This is kind of inside baseball kind of stuff. This is pretty interesting. Tell me, so just say that again about the types of shoppers. So some would be women only. So it's a woman buying for herself.
Yes.
Some you said it's like a woman and girl.
Yes.
For themselves and maybe for their daughter.
Correct. Mm-hmm.
And then some would be household, like, getting it for other people, men.
Well, so it depends. So I'll take Athleta, for example. For your listeners, Athleta is a women's and girls yoga active brand. We have women's and girls product. We don't have anything for men right now. We have our customer file and we can actually see based on our data, we have a certain percentage of women that have girl under 18 in her household. We can look at the penetration of those women who are buying girl product and those who are not yet buying girl product. And we do some research to understand maybe why she's not buying it. She might not be aware of the offering. Like there's all these things, right? We know that when she shops for herself and girl, whether that's her own daughter or whether that's, a friend, family member, what have you, that spend per customer is significantly higher than a women's division only buyer. And if we know there is potentially a girl to shop for in her household, we can do specific marketing tactics to try to get her to buy that division. The same holds if you're, an outerwear only shopper and we want to get you to buy bottoms from us, right? So we can segment the data this way and really understand her existing buying patterns, propensity to potentially buy into other divisions and or categories, and then marketing tactics to really get her there because we know there's value, either by frequency or, spend per purchase. So, that's one very actionable way that we can look at this data.
So in some cases you can say, oh, well, they only buy this one category.
Yes.
And maybe we can get them to buy these other categories. We'll market those.
Exactly. Yep. Yep.
And did you say that you're able to say, oh, this is like Jane Smith here in Gary, Indiana, and we can kind of buy other data on that person and find out, oh, we think she has two daughters who are in high school.
So there are obviously a lot of privacy laws. And so what we can do is at segment levels, do this identification and then send out marketing. So we can say, let's just say there's 100 people, 50% of them have girl and household, but only 25 of them are buying from us today. Let's target marketing message to that other 25 to get her to buy. It's a little bit harder from a one-to-one standpoint in terms of actually pinpointing Jane Doe, but we're able to target that segment exactly and try to get her to convert.
Oh, wow. Okay.
Yeah.
So that's one way of segmenting them. And then
sure.
are there other ways? Like, do you look at, oh, some people would be maybe just, oh, they're just like a Christmas shopper or something, or
Absolutely. And so this is actually a perfect segue into another metric that we look at. Very, I'll call it cousin sister to the rolling 12 spend per customer. It's customer lifetime value. And so this can take into account not just a rolling 12, but more of the total revenue or value of a customer over the entire duration of the relationship. And you can do the analysis you're speaking to, which is segmenting by, I'll call it, time of year purchase, or sometimes we'll look at sale only shoppers, and really understand the true value of that customer over time and say, is it worth spending marketing dollars with this audience? Yes or no. And so that's an analysis that we do to really focus our marketing and commercial tactics towards the higher value segment. So if, in your example, you might have a holiday only shopper, we might spend dollars during a certain time of year to her, or we might identify a subsegment within that population that we say they actually can and should be buying from us other times during the year. And, we'll maybe do a different tactic towards that group, or we'll identify within the holiday shoppers. Oftentimes it's men during the holidays that spike, or during Mother's Day or whatever. And we actually we put them through a separate kind of marketing track. And we're not going to talk to them throughout the year, but we'll talk to them during key moments of gift giving. So it does help us really focus our energy and efforts on valuable customers. Other ways we segment, like we look at one and done shoppers. We might try to do kind of a retargeting strategy to get them back, but then we say, you know what, we actually cut the tail off and we say, all right, we're not going to necessarily talk to them. And then we, think about our discount only customers. They get a different set of marketing than, our best or highest value customers. So again, just a very valuable way when you have a limited set of marketing dollars, or even when you have a large set of marketing dollars, to make sure you're getting the biggest bang for your buck.
one thing you were saying there, I want to follow up on, which is let's take the example of the men who were the Christmas shoppers, and you would market to them at certain times of the year.
Yes.
Now, my question around that is sort of broadly for any party who's listening who sends out any kind of messages, which is, I bet that there's a trade-off that you're thinking about, which is like one might say, well, why not just, spam them all the time, like email them every week, because you never know, maybe it's their birthday.
Right.
But probably every time you send out the message, some percentage of people are going to unsubscribe or mark you as spam. So, but even unsubscribing is because then you've lost them. Maybe it's 1% or who knows. So you're always sort of weighing that of how many extra sales am I going to get versus they unsubscribe in March, then I can't email them in November for the Christmas sale. So talk to me about how you think about, the frequency of the messaging and getting it the right. So, because you're going to lose people every time you email them.
Yeah, it's such a good question. And it applies not just to this, potential gift giving segment, but quite frankly, our entire file. There's always this delicate balance of communication, what becomes just noise and clutter in the background. We do a lot of testing on our messaging, our frequency, all of that to try to optimize for sales. What we have found for this specific audience, the men, we do find, just these key moments are a lot more effective for us, and in the long run have generated better sales for us. Similarly, audiences like our discount only shoppers or, other audiences, we're not going to put them into a track where they're getting, a new arrivals message all the time, whatever. Like they will be getting our, key sale moment messaging and, maybe like one or two to try to get them up, but we optimize. And once, we're not going to say if you're a sale customer, you're always going to be a sale customer. We do test, but we recognize those customers, if they got an email from us, 5 times a week, they don't want that. So we do try to do a lot of testing to optimize because it is a trade-off.
And I imagine there's a thing about you can train people to be a discount only customer. Like Shutterfly has trained me. So Shutterfly has, I buy these photo books every year for the family, and they've basically trained me. Just wait till they give you one of these free pages offers. So I just, we'll get the book ready and I'll just wait for that. So I imagine that there's a thing where you don't want to send out discounts to, too often to your,
full file,
to your full file, because you'll teach them to just wait for that.
Absolutely. It is a very dangerous game. And I will say retail overall has gotten much more promotional, Athleta included. And it is a very delicate balance of, optimizing for, your budget, your number you're trying to hit versus, the overall brand health, which we can talk about next. Because the moment you start to put, promotion on top of promotion and you're going out to your full file, you're teaching her to wait. And if you're doing some sort of sale, once a month or once every other month, and your average customer is shopping, 3.8 times a year, that's when you start to see some of these customer metrics. Your sales per customer are going down, but you're like, well, frequency is going up, but oh gosh, it's because her basket size is going down. Her units are going up, but it's the average price that she's getting this at is discounted. And so there's certainly some of that, not just at Athleta, seen it at many other brands, because you kind of get hooked on that. And then it becomes a really challenging pullback, right? You start trying to pull back on the promotions and your sales are going to, reflect that. But overall, you might be in a better place from a profitability standpoint, as well as from just a brand standpoint. And you have to kind of build back to that health.
Let's talk about that brand
health. Yeah. So brand health, super, super important to keep a pulse on this. There's, many ways you can look at brand health. I would say, the way that many people look at it, Net Promoter Score, that's basically a measure of customer loyalty and brand advocacy. Net Promoter Score, it's often NPS is how you might see it show up. This is typically gathered information through surveys. Questions asked around how likely are you to recommend us to a friend, other questions of that nature. A Net Promoter Score is basically a calculation of taking your percentage of what we call promoters, then you subtract out your percentage of detractors. So promoters are typically folks who would rate you like 9 or 10 on this kind of how likely are you, whereas detractors are 0 to 6 is if you would score there. And so then you get a percentage. You take those percentages and you subtract them and you get a Net Promoter Score. Now, you can't just do this once. You need to do this over time so that you track, how are you doing? Are you doing better than? Are you declining? And, as with any change in a score like NPS, you want to understand why. So uncovering kind of the questions below are really, well, what caused you maybe to change your perception? Or why do you feel that way? And so NPS is a good way to keep track of brand health and just overall sentiment. So that's something that, we look at regularly, and, it does help you just really understand how folks are perceiving your brand and your, out in the marketplace.
Beyond that high level metric for brand health, are there other more specific ones that you look at, like this thing we talked about sort of the discounting addiction, or about just how people, not just the promoter score, but what people are saying about you?
Yeah, so there's a lot of social listening that we do to really understand like keywords that are kind of tracking for your brand. So we get a lot of, we do a lot of third-party research with, customers that we're pulsing polls like on a monthly basis. And so we'll look at, what words are associated with your brand? How is that changing over time? We do a lot of bespoke consumer research as well, where we're tracking key, metrics around our brand versus key competitors. So, we have kind of a set that we do every year, and we're understanding, are we improving on certain things where we have strategic goals to improve on? How are we doing versus our competitors? So those are, again, a bit proprietary and very bespoke to what your, goals are. But we do a lot of that work. Quite frankly, a lot of the best customer research you can get is like going to the store, being a fly on the wall, or even doing impromptu focus groups with your customers. You learn so much, especially when you don't identify yourself and you go into the stores and you kind of observe. I've actually gleaned so much from doing that myself, kind of a secret shopper, if you will.
At your own stores.
At my own stores.
Yeah. And did you also have one of these things like some companies do of go work in the store for
Oh
a day
yeah.
every quarter or something like that as a
Yeah, we do.
perk?
Definitely, as new hires, we put all of our new hires through a process where they do go work in the stores. As leaders, we would go work in the stores during the holidays. That is one, I think, just a great way to show support of the folks who are keeping your business running on a day-to-day basis. And then two, you learn so much. And just the sheer volume of folks coming through during some of these key moments, you see a lot. So absolutely. Boots on the ground is still alive and well. Of course, with ecom too, there's so much you can get from product reviews, as I mentioned, social listening. There's just a lot of different ways that you can get customer data. Now, what we find, and one of the challenges is, all right, now what do you do with all of this, right? You might be getting, the bespoke surveys that you're doing. You're getting, regular metrics from, your site that you're kind of getting. And so how are you actually pulling this together in an actionable way? As a leadership team, we do spend time kind of working through that because there's a lot of data and a lot of noise out there. And so really figuring out what matters. I like to go back to some of those big three metrics and then some of the customer metrics that we talked about, because you do have to stay a bit focused, right? Because there is so much data out there today. And I'd be remiss if I didn't mention one more metric, especially important as you're a newer brand or entering a new market: brand awareness and customer acquisition. Those are critically important as you're kind of building up in a new market, or potentially, you launched a new product. What customers are coming from that. And so, looking at aided and unaided brand awareness and tracking this over time, again, by customer segment, if you can, super, super important. It helps you really get a picture of your overall brand health.
Wow. I feel like I just went through a whole business school course on retail. Jenelle,
Great.
for listeners who want to track what you're doing or find out about your consulting practice, where would you point them online?
Yeah, so you can go to our website. We are farviewpartners.com. That is Farview spelled Farvue. You can also email me directly at Jenelle@farviewpartners.com. It's JENELLE @farviewpartners.com.
We will include those links in the show notes. Jenelle, thank you so much for joining today. This was hugely fun and informative.
Absolutely. Thanks so much for having me, Will.